I'm here again with Andrew Hollingworth from HollAnd Advisors. Andrew, thanks very much for joining us. You're a research house, in effect. How has MIFID II affected you, and how has MIFID II affected the industry? Has it been a good thing or a bad thing?
I think it has had unintended consequences. And we look at this in a lot of businesses and a lot of industries we have what's called first order effects and second order effects. And the second order effects is the things that you didn't think were going to happen or you didn't anticipate were going to happen. And I think when MIFID II was brought in, the first order effects was let's get the fund managers to pay for research, which is not an unreasonable thing to do. And if that's what the regulator wants to get them to do, fine. And then the fund managers can decide what's good value and what's not good value. The second order effect, which the regulator never anticipated and I think has ignored or chosen to ignore, was what the banks did as a consequence of that rule. What the banks did is they then said, right, if I can't make any money in research, I'll just give it away for free. But you can have as much research as you like, Mr. Client, as long as you do your dealing with us. So the banks have then effectively rebundled research to secure that ABC asset management that runs $1 billion has a relationship with JP Morgan. And in doing so, they have effectively undercut the independent research industry that the FCA was very proud to establish in the first place.
But isn't that in breach of MIFID II?
I don't think so. I think the MIFID II was designed, from my understanding, I'm not a regulatory specialist, was my understanding was MIFID II was designed to get the fund managers to incur the cost of research. Unbundling, which was some years before, was designed to separate execution from research. But I think what's effectively happened, that second order effect, has been a rebundling, and it has enabled the bigger institutions, the bigger investment banks, to basically win the research war with independent research providers that arguably they were losing.
And can you talk a little bit about your view on the margin of safety? You know, you want a margin of safety with whatever you're buying in. How do you gauge that?
The simplest way, I think, is if we make the assumption that you've looked at a business and you've decided that business is a good quality business, it's got resilience in it, it's got something in it that the customer likes, which means it's either got a sticky brand like Disney or it's got the lowest cost producer like JD Wetherspoon or something. If you take that bit for granted, then I think the margin of safety comes from obviously not overpaying for the shares at the starting point, but it also comes, I think, from the level of profitability at which you're buying it at. So is this business that you're buying it at operating on peak margins, mid-cycle margins or low margins? And in a perfect world, you'd buy a business that's under-earning and underpriced. Now,
which is unusual. Not many people look at it like that.
But you're not going to get that many of those, because if the stock market's doing its job, when earnings are depressed, the stock market will say, I know earnings are depressed, I'll pay more for it. Yeah. But there are businesses that are unusual. So JD Wetherspoon's, we think JD Wetherspoon's operating margins could be 50% higher than they are today. They are where they are because they choose not to put prices up. But that's a really good thing, because it says to you that there is pricing power inherent in this business if they choose to use it. Now, they might never choose to use it, but that means the customer's getting a great deal, which means that they might get more volume growth. So, it's never quite just one variable, but I think the combination of looking at what am I paying today, but also what level of profitability is the company making today. And in a perfect world, if one or both of those is low, then you're getting a reasonable margin of safety.
And in terms of risk management, do you constrain your position sizes? How do you manage your risk? Or do you, set, I suppose, a stop for when something sinks below where you, or doesn't do what you think it's going to?
Yeah.
Or do you have a target price? How do you manage your risk?
We don't have stops. We don't have target prices. For no other reason than I think they're slightly sort of speculative and trading in nature. And I think if a business is compounding well, some of the examples we've talked about, you want to be careful by selling it too quickly just because it got to a target price. The business might have evolved and become a better business. So that's why we wouldn't have tops. In terms of stops, I just think, if you're doing your job and if you've really analysed the company well and it falls 30%, well, either it's a really, really good investment now or you made a mistake. And in one situation, you should be selling it, and in one situation, you should be buying it. So having a firm stop that says I have to sell it is possibly a way to destroy value, not create value. We just think about risk as the permanent destruction of value. I don't. If you ask me to calculate an R squared or whatever these calculations are, or volatility metrics, I couldn't calculate them. I don't know how to do them all, and I know they're all the rage in terms of hedge funds. It's just not how we think about risk. We think about risk as how are we going to have a permanent destroy of value at both the stock level and at the fund level. So we think about it in terms of as an absolute investor. I'm a significant investor in the fund. It's not lost on me that it's my own money as well as everybody else's. So it's the permanent destruction of value we're worried about, not temporary issues. The only thing I would say about temporary issues, if you feel, let's say, the stock markets were extremely high and there's very little value available, it might be the right thing to have some cash because it creates opportunity where share prices were to fall. We don't do that often, but it might happen on occasions.
And in position sizing, do you have a limit to how large a holding that you'll have in any one position?
Well, as we're about to become a UCITS fund, we've got the UCITS constraints of that, and we've been running a sort of compliance process in line with that for quite some time now anyway. But how we think about it, we have a sort of a 4 to 6% position is our sort of standard position, if you like. So 6% is a sort of full position where we think we really understand the company well. It's doing what we expect it to do. It's allocating capital well. It's cheap against its growth rates that we expect. And a special situation position might be more of a 2% or a real push 4% position. And a very extreme franchise position, if something's, we think it's done extremely well, it's really well valued, but then something else happens that pushes the share price down even more, well, we might then go to an 8% position. But we generally have the odd 1 or 2 8% position in the course of a year. Most things are between 4 and 6%.
And if you've got a 6% position and it does extremely well in a relatively short amount of time, so it doubles and it's gone to a 12% position, what do you do about it? Do you top slice or?
I think it hugely varies. The 6% positions we have might not double because they're going to be compounding over longer periods of time. So it's unlikely they would double in, say, a year, let's say. So it's unlikely you would go from 6 to 12 immediately. Clearly, we need to do what's allowable within our diversification rules of UCITS, but we're not forced to sell it. I think the key thing for us is just to constantly reevaluate the business. As per companies we talked about earlier in terms of things like Dark Group and so on, the big mistakes, I think, in investing are selling good companies too early. And so when those situations arise, you have to stop yourself and say, am I just selling this because it's gone up? Or am I selling it because actually it's not a good company anymore? And if it's for the latter reason, well, maybe that's right. But if it's the former reason, well, you probably should just put it off for a bit and think about it a bit longer. That's what we're trying to do. I think it was Munger that said there are 2 ways they make their money, which is the thinking and the sitting. And of the sitting, that's where they make the most money. And I think as I get older, I'm trying to do a bit more sitting and a bit less selling a stock because it's gone up, because I don't think that's actually the way to make long-term money.
So you have about 20 to 30 holdings in your portfolio. It's said that the best returns are achieved by having a very concentrated portfolio. Is 20 or 30 too many?
Could be. I think each investor just sort of finds the point at which that they sleep best at night and they have the right sort of balance of both opportunity and diversification. And we do have 20 to 30 holdings, but as I've alluded to, some of those might be 6 or 8% positions and some of them might be 2% positions. So we are still able to take some quite significant bets, and we probably are quite close to what we're allowed to do in terms of a UCITS structure, in terms of the 40% positions. We believe in concentrated portfolios, and we agree with you that that's the way that you're going to make outsized returns. But I think having a tail of other holdings that you're interested in, the businesses that you feel like you've either owned before and you've sold a little bit, or you've bought a bit and then the share price has gone up, I think it's not a bad way to run money, and it's a way that sits well with me in terms of giving me opportunities to look at different ideas. And
do you have a rule around cash and how much cash you can hold?
Don't have a rule on it. No, genuinely, it tends to be an output of what else we're finding or not finding. The cash positions we've run have varied from let's say they've varied from 2% simplistically to 10%. To over the years that we've run the fund. It just so happens today our cash position is high. It's about 18%. And that's just because I felt a couple of weeks ago the markets were rather sanguine about coronavirus and just felt there was a number of shares that might move disproportionately if people change their minds. So you happen to have caught me on a day or a week where we've got a high cash position, but that probably wouldn't be the case in 6 months' time.
And you did say that cash was an opportunity, but equally it can be an opportunity cost. It's a very difficult one to play and time the market right. What's your view on that?
In terms of timing markets, I don't think, I'm certainly not any good at it. I don't think there are very many people that are. I think your expression about cash is obviously right in terms of both cost and opportunity. I think there's a lot of people right now, potentially almost all investors or too many investors right now, are only thinking in relative terms. Bonds are yielding me 1%, therefore anything that pays me more than 1%, that's great. So I'll pay 50 times earnings for something. I see the logic of that, but I also see the danger in that. And all the best investors that I've learned from don't think relative, they think absolute. And so we try and approach the returns of the fund from an absolute manner. Now, in some ways, that might have held us back in the last few years because we perhaps should have embraced some shares that we could have owned for longer that had gone on to much higher multiples. I think that's easy with hindsight, but I think it is right to think about things. You don't spend relative money. You know, my investors, if they sell my shares in years to come to pay their pensions, they won't spend relative performance. They'll spend the absolute money that's in the fund. And I think there are too many investors that have slightly forgotten that.
And do you think that we're in a high-risk environment?
Howard Marks, who I really respect, talked about this this situation a few days ago. And he talked about the fact that when prices are high, by definition, risks are higher because surprises happen when prices are high. When prices are low, risks are lower because more things are priced in. And I would totally agree with that. And I think that risk and return are the other side of the same coin. And we've had a very good run in equity markets for a very long time. I think the other thing you could do is if you went back to sort of 2011, when markets were low, everyone was extremely focused on the macro. What are interest rates going to do? What's going to happen with deflation? What's going to happen with money printing? And not that many people were doing stock picking. Now the situation is completely reversed, where everyone is so fixated on having to be invested in the market because bonds are yielding 1, I'm right to buy all these shares on 30 times, 40 times, it doesn't matter. And they're not looking to spending any time on the macro. And I just feel that the truth is somewhere in the middle. And I just feel it's right to be... So we don't look at our portfolio and say, we'll buy that stock on 30 times because interest rates are 2% or 1%. We say, well, look, is that a fair price to pay for a business in any interest rate environment? And would that be a fair price to sell it at? So we try to think about it in absolute returns, both on our capital and on the capital invested in the individual companies.
And what's your view on meeting management? Do you think it's a good idea? Do you think it's a bad idea?
Oh, it's definitely a good idea because you get to understand the business better. I mean, we're generally trying to meet management whenever we can. It's interesting, actually. You can have a UK company that might not have great disclosure on its report and accounts, that might meet investors occasionally, which might seem like you're getting good management access. But actually, if a company in the States has a quarterly transcripted conference call where every single question and answer is provided on the internet to every potential investor 24 hours later, well, that's pretty good access as well. And so I think from our perspective, it's about, are we getting enough information, both before we purchase the shares and after we've purchased the shares, to say that we understand this business well enough? And that can be because we meet the management a lot locally, or it can be because we've got good access to the information available internationally. So it varies, but obviously meeting management, I think, to better understand the business is right. I think meeting management for them to sell to you and convince you how good an investment their shares is a different approach, and one I think I'd be wary of.
So if you don't feel you're getting the communication from management that you need, will it put you off buying into a company?
Well, I think you would expect me to say yes to that, but we've owned shares in Sports Direct Frasers now for a while, and you try and have a conversation with Mike Ashley. I mean, he's a law unto himself, And some of the people, we love owner-managed companies. We love companies where there is a person at the helm that run the business, founded the business, has a real passion and drive for the business. And for whatever reason, Mr. Market has decided that they don't like that person anymore. And those can be wonderful opportunities. But by definition, those people are mavericks. And you have to decide whether or not you're getting enough information or not enough information. At probably the very lowest point of the stock market's confidence in Mike Ashley was last summer, when they were delayed the releasement of their accounts because of a tax issue in Belgium. That was also the very lowest point of the share price, from which it's doubled. So the answer is, of course, yes. Of course, we want to have access to management. But sometimes you'll have to also accept that they have got a business to run, and they might not like the city at that moment in time. So they might not want to meet you.
And will you invest in companies where there are not owner-managers or management own a very small, if any, shares in the company?
We would. I mean, I think what we tend to look for in management is what we call three sort of attributes we'd want them to have. They're great operators, they're great generators, and they're great allocators. So they're good at what they do, they generate good returns on capital, and then when they allocate the capital, they allocate it well. So if someone owns a very small percentage of the shares, but is a chief executive and they're doing those things well, and we believe that chief executive has got the best interests of all shareholders at heart, and we can see that in the history of the company, well, yeah, we probably would buy the shares. And we'd probably encourage the board to give him more shares because he or she is doing a good job. We get a little bit more circumspect when maybe it's a private equity fund that's brought the company to the market, or there may be a different agenda as to why the business is being sold. That's a slightly different kettle of fish. But I think certainly it's a question of looking at what are everyone's intentions and what have they done historically in terms of the management decisions that those people have made and the capital allocation decisions those people have made. So we would, but obviously investing alongside an owner-manager is our preferred place to be.
Does that mean you don't invest in IPOs?
I mean, you can never say never. I can't think of an IPO we've invested in the course of the time I've run the fund. There may be one, but generally it's not our preferred place to go.
Do you look at IPOs, or do you pretty much ignore them?
Not really. I mean, we've looked. There's a couple of companies that came to the market actually that now you mention it. So Fever-Tree we should have bought. Fever-Tree is a stock that actually, bearing in mind, we know companies like Coca-Cola very well. I didn't spend enough time on it. It came a little bit more expensive than I wanted. I should have paid up for it. And the other one we looked at the IPO, which we would have bought at the IPO, but we just didn't come at a price we were happy with, was AJ Bell. So we try and look for businesses that we think are quite, we could talk about compounder businesses, which is the JD Wetherspoons and the Schwabs of the world, but also what we call rare birds, really, really unusual companies that could have really, really special valuations one day. Disney is one of those types of companies, but I think Fever-Tree, AJ Bell justified those sort of justified high valuations, and if we could have bought them earlier in their life, we would have done.
And coming back to franchises, are there any that you passed that weren't necessarily IPOs that you just thought were too expensive, that you look with whist now?
Well, that's what, yeah, I mean, that happens all the time. I mean, I think if there's, it might seem a strange one, but so we spend a lot of time looking at the sort of flywheel businesses that we've talked about. So businesses that invest the benefits of scale back for others. A really early adopter of that model was Costco. So we know the Costco model pretty well. Never bought the shares. They've always been on 30 times earnings, so it's never bought it. But a company that copied the Costco model online is this very small company called Amazon. And actually, people that understood the Costco model, it wasn't beyond the wit of man for those people, which included us, to sort of say, hang on a minute, that's what they're doing. Now, so those types of companies, you do look at them and then you go, I was never prepared to pay the valuation I was being asked, but my goodness, they've gone on to achieve some unbelievable things using a business model that I did understand. So there is obviously those regret in many companies.
Did you see the Amazon Web Services part of Amazon when you looked at it? Because that's been its redeeming factor.
Amazing, yeah. I mean, we did some work on IBM a few years ago, and we looked at the Amazon Web Service businesses at the time, and it was just remarkable how they built that business out of nothing. Yeah. And we're a big, and we've talked about the managers that we love and respect. And another person we've really liked to have a history is called Phil Fisher. And Phil Fisher wrote a very interesting book on growth investing back in the 1960s. And it was all about how businesses pivot and how they find new areas to generate areas of growth for outside the existing business. And that was a brilliant example of that.
Yeah, absolutely. So over the history of the fund, what do you consider your worst mistake? And what did you learn from that?
I think the worst mistake is selling things too early. And it's sort of easy to look at a 2% position that you bought, which you thought was a cheap stock and ended up being a cheap stock because it was poor quality rather than just undervalued. And then you sold it when it was a 1% position. And that's easy to say, well, I bought X and it was worth half X and so on. But actually, I think the biggest mistakes are putting 5% of your fund into something, watching it go up 100%, thinking you're an absolute genius, and then being in a rush to sell it. And then years hence, seeing that business has compounded and compounded and compounded. And I think those are actually the big mistakes. So I on my wall, there's a little expression from another investor that says, buy right, sit tight. And I haven't sat tight often enough, and that's something that we're trying to do a bit more.
But equally, those that did buy Fever Tree and saw it go right up to the top are now sitting there and saying, I wish I'd sold it.
Well, maybe. But I think there is still an element of apathy is an underappreciated investment skill. And if you're half good at finding good businesses, then buying them when they're not overly priced and then just never selling them is not a bad way to go about it. And obviously Buffett's made a good fortune out of doing that in more recent years.
And what's the best decision that you made for the fund, and what did you learn from that?
We had quite an interesting experience with the US banks. So there's some very old research on our website which talks about my views pre the credit crunch, where I felt there was some warning signs for that. So I wasn't particularly interested in the banks prior to the crunch. But I think that there was such a washout of risk, hatred, recapitalization, regulatory backlash on the US banks that they became so depressed as a sector in 2010, 11, 12, and so on. And we then built some positions in JP Morgan, in Bank of America, and Wells Fargo. We even had the warrants of some of those businesses as well, which were long-dated warrants. And we made some really good money. In our 2017 year, we had a really big rise in the fund NAV because of that. And that was a really sort of big moment, payback moment for us, if you like. What did we learn from it? Just patience. I mean, anyone that saw our portfolio, anyone that talked about banks, all that was being talked about up to then was how risky they were, how dangerous they were, how they were uninvestable they were. And now people, we bought JP Morgan at $55, $60. We sold it at about $115, $120, and it's $135 today. These are good quality, well-run businesses by good managers. They just happen to be finance companies. That doesn't mean they were pariah businesses. So we bought them when they were hated, and we made some good money out of them. But it was hard. You have to be patient, and you have to, stick by your guns when everyone else is telling you you're wrong some of the time.
It's interesting, both with your worst mistake and your best decision, your learning out of them is be patient.
Generally, yeah. And I think that's just, we spend a lot of time, listening to and spending time with and studying other managers. And the really good ones, spend time thinking about businesses, owning a small number of businesses, making small changes to their portfolio. They're not buying and selling every 5 minutes. They're not looking at every IPO that comes along. And that's really where we're trying to get to.
So we're now at the beginning of, February 2020, and we've got coronavirus happening. And the markets have been very highly priced. What do you think of the macro picture where we are now, and what you think we're looking towards for the rest of the year?
In our letters to investors, we talk about macro as being the wing mirrors in the car. And by that, I mean that I think our main job in terms of sort of being a portfolio manager is driving the car and trying to pick stocks and trying to find in companies that we can own for the long term to compound. But the wing mirrors, you wouldn't drive a car without looking at the wing mirrors occasionally. And the macro is the wing mirrors. It's, what's going on around me. And most of the time, there's nothing going on around you. Most of the time, there's nothing to panic about. But just ever so often, there is something that comes along that should make you pause and reflect to think about, what are the risks here? And I think that was obviously the case in hindsight in 2008 and so on. And I think the higher markets are, the more by definition you need to be slightly more cognizant of the risks to changes in them. And particularly in the individual companies. And by that I mean, I think the coronavirus situation is quite interesting because it hasn't arisen at a time when stock markets are low. It has arisen at a time when stock markets are high. And stock markets swing in a pendulum of fear and greed, and they tend to overswing from one extreme to the other. And so to say that coronavirus is a definitive reason why the stock market should go down is obviously wrong. But it will be interesting to see how the mentality of investors, the mentality of commentators might change if coronavirus becomes a little bit more widespread and we have some of the knock-on, not so much economic effects, but just consumer. The consumer will retrench and will just spend a period of time saying, well, what am I going to do next? And there are periods of time when maybe the stock market was happily pricing that in. I'm not sure it's pricing it in today.
Some believe that it's just central banks propping up anything that happens, and therefore it's not really excited the markets as much as it might have done to the downside. Do you think that's true?
You mean as in...
Coronavirus has really had very little, well, it has today and yesterday, but it's had very little impact on the markets because everyone thinks that central banks will bail any problem out.
Yeah, I just think that's a dangerous place to be. I just think that... I forget, it was an expression that Buffett said years ago, which is something along the lines of why they didn't have much debt in Berkshire Hathaway. And it was about something of not waking up tomorrow and being at the mercy of others or being at the mercy of others, sort of, you owing them money. And I think it's the sort of same thing with that sort of mentality. Is you should own a share in a company because you think it's a great business that's got great compounding prospects going forwards, and if the stock market was closed for 10 years, you'd have no problem taking your dividends. If you only own shares in a company, or even worse, in an ETF or index fund or whatever else, you only owe them because someone's told you to, and you think the central banks are going to make sure you never lose money, I think that's quite a dangerous place to be. And I sort of feel there are one or two investors in that place, which does make me a little nervous.
So if investors want to find out more about the fund and want to buy into it, how do they go about it?
The best place to go is our website. On the front page of the website, an investor can just put their email address in, and that will then give them some updates of research ideas that we send to anyone that's interested in for free. Further on in the website, they can find details about the fund. We're expecting the UCITS fund to launch in probably early May this year, and anyone that's interested can give us their details and we'll get back in touch with them nearer the time of launch.
Because at the moment they can't download a fact sheet, can they?
They can't, and that's because it's an offshore fund, and therefore we're not allowed to put offshore funds onto a UK website, but we can give the existing fund details to professional investors that asked, and we can also give information to retail investors when we are able to launch the UCITS fund. So if they get in touch with us, give us their details, we'll be delighted to get back in touch with them around the time of launch.
Tremendous. Andrew, thank you very much indeed for your time.
It's a pleasure. Thank you for having me.